Okay, good morning, everyone, and welcome to what is the 62nd edition of the Coffee Microcaps Morning Meeting. My name is Mark Tobin. I'm the founder of Coffee Microcaps, and I'd like to welcome you all to this morning's meeting. I'm just going to quickly run through some admin slides, and then we're going to get straight into it with our first presenter. I'd also like to give a shout out to our virtual event sponsors, DMX Asset Management, who have been around the microcap and small cap space for a good number of years now. They run two funds. So if you're looking for an active fund manager in this space, be sure to check out the PDS available on their website. Quick compliance and disclaimer slide. For anybody joining us for the first time, the companies we generally have on here, generally also on a weekly basis, capped under 300 million in revenue and approaching cash flow break even, or ideally already profitable. We generally don't have companies from the resources or biotech sector, so what I call industrial microcaps, which can encompass microcap tech, microcap consumer goods or services, microcap healthcare. We cover all the kind of other sectors. Structured this morning's webinar, as always, a 30-minute presentation slot for each company, broken down into a prezzo and then 10 minutes of Q&A. If you do have any questions for our presenters, please type them in the Q&A box rather than the chat function. Just makes it easier for me to moderate the questions to our presenters. Please note the webinar is being recorded and it will be posted on the Coffee Microcaps YouTube channel early tomorrow morning. You can follow us on all the main social media sites, Twitter, YouTube. You can subscribe to the YouTube channel to get updates of all our future content when it goes live, LinkedIn. And I also write a weekly paid subscription newsletter where I profile one interesting microcap stock every week generally, and that's on the Substack newsletter platform. First up, we have from the Sustainable Nutrition Group, Neale Joseph. I'm delighted to be welcoming him back. And after Neale, then we're going to hand over to Shaun Ankers, who is also a returning presenter from Energy One. So without further ado, I'm going to stop sharing my screen and hand over to Neale. And Neale, if you want to start sharing your screen.
Yep, 1 second. Where am I here? Yep, got it.
It's coming through now, Neale. Yeah, and if you want, there you go. Perfect.
Great, Mark. Thank you very much, and good morning, everyone. And thanks for joining me here today for this presentation and update. Over the past 12 months, the company has evolved significantly. We began as a hemp ingredients business, processing and selling hemp seed and hemp oil to the ingredients industry. Since then, the company has begun the execution of a plan to move both up and down the value chain, where we now deal directly with seed growing, farmers, production, third-party logistics, third-party manufacturing and distribution, and direct management of retail customers and consumers. So we now play in every part of the value chain. In addition to that, we're building brands. We're dealing with leading grocery and pet retailers and e-tailers, as well as broadening our range of core products to include Australian native ingredients. In addition to all of that, we're investing in sustainable competitive advantage through real innovation, through partnerships with industry leaders such as Australian Plant Proteins to create isolates and concentrates that are unique, IP protected, and have global scale. All of this is underpinned by the growing momentum for consumers' sentiment and demand for sustainable and plant-based products and brands. Our research shows that significant market shares gained and changing consumer purchasing patterns. Over 32% of Australians now eat less meat or call themselves flexitarians. There's been a 46% increase in plant-based grocery sales since 2020. And there's over 200% increase in plant-based products in Australian supermarkets. Now, supermarkets is only one segment. We've seen similar type of trends in food service, in fast food restaurants, and not just in food, but actually across a number of categories as this evolves. But the sentiment's one thing. the products still have to perform. So in our world, they must perform on taste, they must perform on quality and value for money. For consumers to be able to trial the product when they've got a desire to eat less meat or be more flexitarian, and then with a good consumer outcome to repurchase and grow. The driver of this for us will be constant innovation and product development, which will be the lifeblood of our success as we go forward. We remain focused on human and pet nutrition in this first phase of our development. Also, key to our growth is to have a balance between contracted income streams and trading income, and we're well placed across both of these areas. Mount Elephant is our disruptive plant-based brand, and it continues to gain momentum. With distribution in Coles, Woolworths, health food stores and e-commerce platforms, we've set the stage for growth that will be driven by improved sales performance, product innovation, new category entry and international distribution. Field Day, our pet nutrition and supplement brand, has been established with a limited range that's about to be expanded later this year. The focus is on pet supplements, which is now the fastest growing category in the US and in Asia Pacific, and is a huge opportunity for us as we start on this path because this category is nascent here in Australia. Our recent acquisition of the Australian Superfood Company broadens our range into the fast-growing Indigenous ingredients market. I'll talk more about this later. Combined with our Australian primary hemp brand, these are the drivers of our contracted ingredients portfolio moving forward. Our first half showed strong revenue growth, albeit from a low base. As has been reported across many companies and industries, supply chain challenges are real and impactful. If you look at recent announcements from companies such as Coles, Woolworths and Bega, they've all taken reasonable impairments as supply chain has impacted them, primarily coronavirus driven. But you now overlay that with significant weather events in Western Australia, which stopped the rail line running for several months, meaning that for those of you on this call in WA, you would have seen the shortage of product across the portfolios in major supermarkets and delicatessens, and even in food service. That also impacted South Australia with the rail lines cut. In fact, I read an article the other day which highlighted how Woolworths had actually chartered a number of ships to be able to take product from the East Coast to the West Coast because it was the only reliable transport route. We're now experiencing significant weather events in Queensland and New South Wales, which will have impacts on supply chain and being able to get product to store where we have distribution facilities closed, where rail lines are cut, and where roads are cut. All of these things are part of the joy of being in Australia, but where they certainly impact business. And I can tell you many stories of people I've spoken to in different parts of the supply chain that are affected. Our gross margin improvement over this time reflects our evolving revenue mix from ingredients to branded. But both channels have really strong pipelines for us. This mix will continue to evolve as we progress. Our Mount Elephant brand continues to grow and evolve, with sales increasing 12% half on half. We continue to invest in marketing, product development and innovation. And our focus for this brand is on large categories that haven't had innovation and we will bring sustainable, tasty and delicious products that meet mainstream consumer requirements. We'll continue to innovate in product, packaging, pricing and consumer insights as we drive growth in this very exciting brand. To that end, yesterday, we announced a new distribution agreement with Woolworths, extending our product ranging of Mount Elephant to a total of 8 products now, with 4 new products being ranged. And before this call, I was on the phone with our head of logistics, and our first orders are rolling out of the factory today. So we're really excited about that. As mentioned just before, these are mainstream flavour profiles, innovative products, and launched to attract broad consumer appeal. So if I talk a little bit about this particular category here, these products are in the bakery category. That's a $160 million category just in grocery, does not include health food stores, does not include food service, etc. It's growing at 24% as there has been a fundamental shift in consumer sentiment towards cooking and baking at home. This category is dominated by some very traditional players, a couple of Australian players and a couple of international players, whose product offering is primarily processed sugar-laden products. Beautiful taste profile, but not the healthiest option. So our opportunity here is to meet those taste profiles, but be able to deliver a healthier option at an affordable price. We anticipate this will generate approximately $1 million in revenue for our company as we move forward this year. Field Day, we're targeting the large and rapidly growing pet nutrition segment. The market continues to grow post-pandemic. When I first looked at when we first did market research and market sizing, the amount that was spent on dogs and cats was about 12.6 billion. That was in 2019, 2020. If you look at the numbers here from our latest research from Animal Medicines Australia in August 21, that market has more than doubled in that time. We're seeing the largest pet ownership per capita in the world now in Australia, and over 1 million dogs have been added to domestic ownership. So the market continues to grow, and yet what's interesting out of this category is that pet insurance is now become a very significant part as people want to insure their pets, because as they get older, they get sicker. And I've got a dog and I've had to take him to the vet a couple of times, and it certainly is not an inexpensive category, an inexpensive spend actually. So we're working closely with those pet owners and that channel to be able to ensure that our products can give dogs a happier and healthier life, and as owners of those pets, a less expensive investment. So the leading e-tailers and retailers all see our vision. They've supported our existing range, and they're supporting our broader range later this year. On the 28th of January, so just a few weeks ago, we settled on the acquisition of the Australian Superfood Company. Australian Superfoods was founded in 2015, is one of the leading players in Indigenous ingredients. We're focused in the first month on back of house integration and meeting our key customers. This business, which keeps its management team, has a very strong reputation for reliable supply, customer service, and innovation. 85% of the revenue for this business is business to business, and we're now working on joint business planning, not only with our customers, but with our suppliers to maintain and grow our business. And we're getting some very good early traction. As I said, the management team remains in place. They bring 6 or 7 years of real IP and understanding here. So we're excited to be working with them as we go forward. And for those of you who aren't familiar with what some of these products are, that would include products such as Kakadu plum, finger lime, wattle seed, Davidson plum, and pepperberry, just to name a few. There's about 60 products in the portfolio. And if you wonder, well, where are these used? You will have seen mainstream brands like Connoisseur's Ice Cream, Cocoa Black Chocolate, Four Pillars Gin as examples of real leading brands that are using these products. And this is just the beginning and the tip of the iceberg, because the nutritional benefits are significant, the flavour profiles are unique, the products are completely sustainable and traceable, which aligns with our strategy, and we're very excited about how we can grow this new category. Brand distribution continues to grow across retail and e-tail channels. We had a big burst between Q4 and Q1 of this last year and this year. It's stabilising a little bit at the moment, but we see significant opportunity across the portfolio in supermarkets, broadening into the independent supermarket channel, in pet food stores, broadening into the independent pet food channel, a pet store channel. And we're really just getting traction online now. And it's really growing quite quickly and quite significantly. So we're really excited about where we're going to go with Field Day. I want to spend a few minutes just talking about our supply chain that we've established and the operational performance of our business. So when I started with the business, we dealt with about 6 farmers. We dealt with them through a third party manager of those. And our quality was variable. Our yields were variable, and they really didn't have a sense of us and where we were going, and we really didn't have a strong enough sense of how we could improve their lives, and hence how we could improve our outcomes. So a year and a half later, so 2 harvests later, we now partner with 17 farmers, primarily across Tasmania, and over 40 Indigenous growers in the Australian Superfood Company business. So a much broader product range, a much broader geographic spread. And from our hemp perspective, we've improved the farmers' yields by 25%. So we've gone from less than a tonne a hectare to 1.2, and we see further improvement as we go forward, making sure our planting times are right, making sure the field selection is good, making sure the agronomic outcomes are solid for the farmer. What's the benefit? The benefit for us is that we get more consistent quality, more consistent quantity, and we actually get better yields for the farmers, which ultimately will lead to profitability through that value chain and our opportunity to lower farm gate costs in the future, while still maintaining profitability for our farmers. And it's important. This crop is an environmentally sustainable crop. It uses 1/10 the amount of water that most cereal crops use. It has 1 spray of insecticide versus generally 12 of other crops. And it regenerates the soil. So it's a truly regenerative crop. So, and the farmers love it because the yields that they get from the land that they plant hemp in for the subsequent crops are usually better because of the nitrogen and the phosphorus that's put into the soil. This is really important for us because it enables us then to work through our yields in our processing facility in Geelong. We've seen our dehulling yields go up to 42%. Last year, they were 31%, and the year before, they were 17%. So we still think we've got some way to go there, but these type of numbers are very competitive with world's best practice here in Australia and internationally. Also critically important for us because ingredients still represent a very significant portion of our business. Our partnership with Australian Primary APP is on track for the development of hemp isolates. So Australian Plant Proteins is the leader in this space, and we partnered with them because we did a lot of research into how we could develop leverage all of the nutritional capabilities of hemp and be able to make it a mainstream ingredient. And what was critical for us is that it had a high protein level, it was tasteless, it was completely soluble, and it was non-allergenic. And so hemp, unlike any other plant protein, can tick all those boxes if we get the outcome. For us, we wanted a fast to market capital light model, and we've been able to achieve that. Now, we mentioned in October that we were beginning this process, and we said we're going to start that process in January. So we're now at the beginning of March. That first stage is close to completion, and the early results are very encouraging. This will be a unique platform for us, protected by IP protections, trademarking, patents, and the like, and will allow us to enter into the global $10.3 billion plant-based protein market. For those of you who are following this space closely, our partner in this APP announced a very significant deal in South Australia last week, backed by the federal government, the South Australian government, and 2 joint venture partners, where they're going to invest $378 million in a larger facility of the one that we are producing, that we are trialling and will produce in Victoria. They have in their data, they've talked about opportunity worth about $5.8 billion just for them alone, and employing something like 8,500 people. So we see this fundamental shift towards high quality plant-based proteins as critical, and we see our role, we've got a very clear place in it. So our focus, therefore, is about developing a high growth sustainable revenue base and driving to future profits. We'll do this by growing our branded portfolio in grocery and pet internationally, optimizing and gaining increased consumer loyalty and repurchase, and increasing distribution as we move forward, growing our contracted ingredients revenue across Australian Primary Hemp and the Australian Superfood Co, and commercializing true innovation of the isolates and concentrates. So our second half is looking stronger than our first half as we roll out our new Woolworths announcement, and we've got plenty of other opportunity in the pipeline, which we hope to announce to the market soon, as well as progressing our additional commercial opportunities that we see, and just optimizing what we do now. We're very conscious that the market has changed slightly in terms of the capital markets, and particularly in the microcap space. But nonetheless, as prudent management and prudent investors on behalf of our shareholders, we're constantly looking at our expenses. We're constantly keeping ourselves lean because we want to be able to innovate quickly, we want to be able to execute quickly, and we want to be able to deliver returns to our shareholders as soon as we can. Mark, thank you very much for the opportunity to present. If anyone wants to contact me, they can contact me at Neale, Neale at sustainablenutrition.com.au. It's probably the best place to get me. Or maybe after we can send around the email of our investor relations team. Thanks, Mark.
Thanks, Neale. I might kick off on the questions just to get the ball rolling here. In terms of the revenue split that you had, it was, roughly 50-50 between the ingredients business and the let's say the branded products business. Is that where you'd like to keep it, year to year over the medium term with it, a bit of oscillation, 45-55 year to year, or should we expect a trend where one of those two segments becomes more dominant over time?
If you'd asked me that question a year ago or a year and a half ago, I would have said it's probably 75% branded, 25% ingredients. I think as we're evolving our ingredients business, particularly in this new isolates and concentrates area, and as they grow in this early stage of our business, I think we're probably going to see that oscillate for the next year or so. But ultimately, we'd probably like a higher proportion in our branded business and a lower proportion in our ingredients business. But we've seen over the last year or so, particularly as we're growing from this early stage, that when we sign on a new ingredients customer, it has a material impact on our revenue mix. So right now, I'm happy to take the opportunities that are presented to our business and that we create, but ultimately it will be more of a branded portfolio as we go forward.
And if we can stick with the ingredients business, just on the acquisition, I know you call out the Australian superfoods business already has existing customer and export relations to the US and South Korea. What's the kind of split in that business in terms of Australia-based revenue versus international revenue?
So it's 85% Australia, 15% international. And we think we're just scratching the surface on both. We're really putting a lot of focus now on making sure all the technical side and the supply chain side is right pre-significant scaling. The opportunities in the US and in South Korea, we think are also quite in their infancy, so huge opportunities there. But there are also other countries like Japan and Malaysia and the United Kingdom, which represent very significant opportunity for us. And we want to explore those as quickly as we can.
Another one from me on the Field Day brand. Could that end up going, I'm going to say mainstream here, in the sense that it's in Coles and Woolworths, or maybe slightly more, what will I say, organic, like a Harris Farm or something like that? Or is it more a product that won't really get that mainstream, that it ends up there, but it will be, something that would be in every good pet retailer down the line?
I think the right now we're focusing on getting our core distribution and brand credibility with pet food and supplement experts. So the type of retailers and e-tailers we've talked about, Pet Barn, Petstock, My Best Friends, etc. The e-tail market in this space is very strong. The penetration of online sales is about 35% in this market versus, say, 17% in mainstream grocery. And the reason for that is often people buy product, particularly pet food, in large quantities. If you've got a large dog and you're buying a 30-kilo bag of pet feed, you're probably just more than happy to have that delivered to your front door rather than go out to the pet food store and lug that in the boot of your car. So we see ourselves, certainly in this first phase, really focusing on those core retailers and e-tailers. I think over time, we could go more mainstream, and there are lots of evolution in the category management of some of the mainstream retailers that may be looking for a product like this. So we're keeping a close eye. We know from our work in grocery that the retailers and the e-tailers have very clear category plans, and we're in close contact with them all the time. And it's got to be right for them, and it's got to be right for the brand. So there's always that opportunity. We'd never say never, and we look at it on an ongoing basis.
And then if we can just talk about, you mentioned logistics and supply chain issues. One thing you maybe didn't touch on, I'm not sure if it's not a concern or it hasn't shown up yet, but what we've seen in commodity markets with kind of soft commodity prices across the globe rising, fertilizer costs rising. I know you touched on, there's not much on for the hemp farmers in Tasmania in terms of that fertilizer or pesticide base. Is that a concern? Are you seeing any of that yet across any of the brands where just suddenly there seems to be like a big kick up in a particular input cost?
So look, for us, being Australian sown and grown, and really our supply chain goes from Tasmania to Victoria to around the country, we've got limited exposure to freight risks. We've got limited exposure to any of those other risks. We now even grow our own cultivation seed, where in the early days we imported it. So we really have got end-to-end control of our supply chain. So we're not really seeing those risks. There are always the agricultural risks that come across any crop anywhere in the world. You can't control the weather, but we're having a really good crop this year. So look, there are transport costs which are going up, but in that agricultural side, we think we've got it managed pretty well, and we work with very commercial farmers who really understand their costs very well. I think there may be some increase in our harvesting costs this year because of fuel price increases, but I think that will be marginal because it's a small proportion of our cost of sales. So I don't think we'll have exposure to that. We obviously look at commodity prices across the world. I'll give you an example of one that you've just talked about. So chia is a very big product across the markets. There was a crop failure it's primarily grown in South America. There was a crop failure last year. People see it often as an alternative to hemp. That price has tripled in the last 4 months, and that will stay high until the next crop, which is at the very earliest February, March of 2023. So we are seeing that, and that combined with higher freight costs bringing in from overseas gives us the unintended benefit of actually being more competitive on price, because people then are happy to take a small price change to hemp, and then with all the nutritional ingredients, we're now getting a lot of inquiries there. But no, from a supply chain perspective, being Australian sown and grown gives us a little bit of immunity to that.
Indeed, my family are dairy farmers back in Ireland. As my grandfather said, farming is weather and weather is farming. And on that note, Neale, I think we're just pushing up on time. And fantastic. I know, I do believe, yes, he is. Shaun, our next presenter, is standing by. So thank you very much, Neale, for coming back in and giving us an update on all things TSN. And we'll watch out for some of the announcements that are coming through that you highlighted we should expect in your outlook statement.
Thanks very much, Mark. Thank you, everybody.
So Neale, if you could please stop sharing your screen. And
okay, so I've just got to work out how to do that. 1 second. There we are. Got it. Okay. How's it?
Thanks, Neale. And Shaun, if you want to start sharing yours. Yeah, I can see the slide now. If you just want to go to present mode there, it's just to make it full screen.
Morning, everybody.
Yeah, there we go. That's perfect now, Shaun.
Thanks, Mark. Good morning, everybody. Pleasure to present at the Coffee Microcaps now. We've got a bit of a whistle-stop tour today. Just going to have a quick look at the half-year results, a bit about Energy One, of course. For those who aren't familiar, touch on our most recent acquisition of CQ Energy, discuss the strategy, and then I'll take some questions, obviously. Detailed presentations for each of these subjects are available online, but of course you can contact us afterwards and get a bit more information. So if you don't mind, I'll just crack on. A little bit of a background to who we are. Energy One is a supplier of software and services in the energy trading and risk management space. That's basically bulk energy trading, electricity and gas, and associated commodities such as environmental certificates and FX and the like. We have a hybrid business model of a recurring revenue and non-recurring revenue. Recurring revenues are about 80% traditionally. We have solutions for all kinds of trading in both the physical commodities themselves and also the derivatives. We've got offices in Australia, UK, Belgium and France, 300 odd customer installations in 19 countries. Got a good market share in Australia with some of 50% of the energy in this country passing through our software. A much smaller market share in Europe, which is our major runway for growth. And we've got a strong track record of earnings and growth. So that's a little bit about us. Just quickly touch on the half-year results. As we can see here, the top line was flat as we predicted. EBITDA margins are stable and gross margins are stable as well, but obviously I'll discuss why the top line was flat in a moment. But just to also point out that we had some $500,000 of acquisition one-off costs during the half, which came from a couple of acquisitions, our Belgium acquisition, Ankers, and also from CQ in Adelaide, and I'll discuss that in a minute. So that obviously flows through to the bottom line and obviously in the cash flow as well. Let's have a quick drill down on why that result is as it is. As I mentioned, we've got 80-odd% recurring revenue in the business. But 20% is still non-recurring, and that's the orange part here. This is the project T&M. So we get project T&M largely from larger customers who might be in installation fees, training, data migration, any customizations and the like for enterprise-grade platforms, and also follow-up work in the years after that for additional works that are being done. And these are usually attracted to larger customers. So it's a more complicated sort of procurement process. The recurring revenues are what we focused on over the years, and these have sustained through COVID. But the larger customers, of course, with COVID travel being difficult, we've struggled to get in front of the bigger customers and make eye contact. And that's something that's resolving itself as the world opens up, and we're optimistic about that. The pipeline's good. We just need to get out on the road and win some more of these larger jobs. I'll just show this slide here. This is a feature of the business that's been with us for a while. This orange part here is the project revenue. You can see it sort of waxes and wanes as years go by, but we focus mainly on building up recurring revenues because they underpin the business. But obviously these ones do come and go depending on whether you have a bumper half or not. So just kind of come back to that in questions if you like, but let's move on to discuss CQ Energy, which was our most recent acquisition just in January of this year. It is our largest acquisition to date. CQ Energy are a provider of 24/7 operational energy services. They're based in Adelaide. It's a well-established, profitable company with several years track record, and they provide both consulting and operational services mainly to renewable energy producers and also to customers requiring wholesale gas in the Australian market. With 20 staff and 30 customers. So what are operational services? They're basically recurring services, but different from the one-off T&M variety that I talked about a moment ago. So we're talking about on behalf of customers managing their physical energy requirements in the spot, pool and logistics market. What does that look like? In electricity in this country, that means bidding generation into the NEM. Technically it's offering, but we call it bidding. On behalf of clients to agreed strategies, Gas, managing the day-to-day nominations of moving gas around through the network, both in gas supply and gas transportation. Control room services, this is a more detailed level of services in which CQ would control the actual plant itself in response to market signals or market requirements from the grid operator, as well as nominating the commercial side of it. And just as an aside, CQ operate our Pipet software on behalf of a pipeline operator customer of ours. These are recurring services, I should point out. So what they're doing is actually facilitating the entry of renewable generation into the national electricity market or national energy market. They offered, as I said, dispatch, algo trading. They've got an automated trading system, managing contract positions, and so on and so forth. All of these are essential to mainly startup and smaller renewable energy generators, and I will come to that in a minute. So what does this mean? It means Energy One is expanding into the services business. We're both with 2 acquisitions in the last 6 months. Ankers, of course, do something very similar to CQ in the European context, another good business. And of course, CQ, as I just mentioned. So very quickly looking at the numbers, the full financial impact of these 2 acquisitions won't be felt until we get a full 12 months out of them. We've had 1 month of Ankers, and we may get 3 months of CQ if we can get the thing complete by April. As you can see, we're together producing a healthy increase in EBITDA. So let's talk about the strategy and why we're doing this. So we are building this global energy services business to put us at the forefront of the green energy revolution. We've all seen the energy services market in both Europe growing with the development of distributed renewable energy generation. And these businesses give us a head start in that space. We are already very strong in software, and we've been selling SaaS software for a while. And this enables us to provide an additional business line, which is a service to operate that software on behalf of clients, either these small clients who can't do it themselves, or even large clients who might want to outsource that particular aspect of it. It does enable us to leverage that suite of software products. We've got very good software products, and this is another business line to add to that. And we will be focusing on Europe and Australasia with this strategy, but obviously with an eye on US expansion if that an appropriate opportunity comes forward. Again, as the world is opening up to travel, more and more opportunities will be coming forward, and we intend to capture those as they do. But in the moment, we've got Europe and Australasia to focus on, and that's what will be the short term. So what is the revolution? The revolution's already upon us. Energy markets are changing. We talk about decarbonisation, the electrification of the economy, decentralising of generation. There are fewer and fewer large utility installations, and more just DERs. We've all heard about virtual power plants, and of course, solar PV. These are all things that are happening in the marketplace, and it's basically distributing the generation throughout into smaller parcels. And what all this has had an effect on making the market more complex, volatile, and data intensive. So we often talk about generation, and people might think about it as a replacement strategy, especially in this country. You might think about shutting down a coal-fired power station and then replacing it with some wind or solar. But it's more than that, because as we electrify the economy and get steadily off coal and later off gas, we'll need more and more electricity. So this report by the AEMO points out that they estimate we'll need 126 gigawatts of new renewable energy generation in the next 10 years. At the moment, it's about 50. So we're looking at more than doubling the size of the capacity in the market. Same's happening in Europe. 40 gigawatts a year are going in of renewables. That's the entire Australian generation fleet going into Europe each year in terms of renewables. So there's a lot happening as they both shut down and also electrify. What does this mean? It means that the fewer and fewer large generators and more distributed resources. But it also, if you think about it, something to do with, taking one random example of EVs. As I said, we tend to think of it being replacing coal, but every time you plug in an EV, you have additional load that wasn't there before. So in Australia, we sell about 3% of new cars are electric. In Europe, it's more like 25%. So on the basis that there's something like 1 million cars sold in Australia, that's possibly 200,000 more electric vehicles per year sold. If we get up to Europe's sort of penetration standards, that's a lot of electrical load that gets plugged in every night, and therefore the generation is going to be there to provide it. So there's a lot of new generation required. So about us and why we're moving this way. We've been very good at selling to tier 1 customers, large utilities, including large renewables, those who can consume the enterprise quality data, enterprise quality software, albeit in a SaaS format, but they've got the human resource to operate 24/7, so on. They might have the trading desk, the night shift, all of that they require, the systems to be able to do that. What you find is that the smaller renewable generators don't often have those resources. They're usually pure play investment vehicles or single purpose or something of that nature. They might not have the resources to operate themselves, and therefore they need some help with that. And that's what the outsourced services provide. So coupled with software, it provides that solution to these requirements. So we're looking to push down through tier 2 and be ready for when tier 3 and tier 4 come to the market. Tier 4, of course, being mass market. And one day, mums and dads will be able to trade their power freely on the market, and that's something we want to be ready for as well when that comes forward in the next several years. So we'll be operating a global follow the sun service. We're building that out at the moment. 2 different geographically distanced control rooms gives us both redundancy and backup. And we'll be leveraging our suite of software to include process automation, because obviously automation is the key to economies of scope and scale. When we're talking about this, there's no reason why we couldn't have 1,000 customers at some point, but obviously we can't have 700 traders. We'll have to have automation to do that. But the human aspect is about the supervision and being available to control the process and answer the calls from the grid operators and the like. Very important step in the process. This picture here just shows we've got, obviously at the moment, we've got control room in, the picture of the control room in Belgium there, and obviously in Adelaide. And the idea is to provide, to get away from night shifts. Night shifts are very hard and expensive to control, and be able to offer sort of a long day in 2 different time zones, so that we can trade European power and gas from Australia and vice versa, and offer customers a global service. Well, this all combines to cover all the bases, both real-time and forward markets for energy trading and derivatives trading. And obviously the slide demonstrates that between the group, we've got a good coverage of all of the elements, which goes to the core of our strategy, which is providing a wholesale suite of solutions. Has been for a long time, but also enables us to cross-sell both services to the software customers and software to the services customers. So we now post CQ completion, which we hope will be April. We're the #1 provider of these operational energy services in this country, and the #2 provider in Europe. So obviously it's a sizable sort of footprint for us, and something we intend to leverage as a global provider of services going forward. In line with that, we'll be sort of switching to a slightly different way of looking at the business. There's going to be a software part and a services part. Software being all of our software products in the sense that we all know about them, and the services being both the provider of one-off services and recurring operational services. So the expanding the physical side of the market is see a considerable increase in our addressable market size. As I said before, we've been very good in the tier 1 space, but by broadening our solution set, it attracts customers who are smaller, more specialized, and also more sort of diverse is something that we're particularly attracted to doing. And so we're very pleased to sort of entertain the notion that we can address a much larger market going forward. And it's something that we're very excited to get involved in. Okay, just as I say, a whistle-stop tour. Mark, over to you.
Thanks, Shaun. I might just get the ball rolling on the questions. If I know you quickly mentioned it there, I think it was maybe the second last slide on the software piece. You mentioned new battery management software. Is that something you're developing internally, or is that something you're scouting around the market looking for somebody who's got an existing software product that you feel could fill that gap?
Well, that is both is the answer to that question, Mark. We've developed internal battery software for managing and optimizing and bidding batteries into the market. But also we're reasonably agnostic about working with the best technologies as well. So if someone's got a particular technology that we can partner with, we're providing the services after all, and the solution set and what comprises that set, be it someone else's third-party technology, is something that we would entertain as well.
And just on the CQ acquisition, what do you think is the scope for cross-selling there? Of the 30 customers that they have, how many could you offer Contigo to, or one of your other software products, in terms of trying to get that cross-sell up between the new acquisitions and what's already in the pipeline?
Well, cross-selling is a cornerstone of the strategy. So obviously customers are very sticky, and change is difficult when you kind of get to change to you. So it's good to be able to have a relationship with them in one format already and be able to sort of get to know them a little bit better and be able to offer them solutions to different parts of their business. So without talking specifically about numbers, we will definitely be in the business of approaching those customers and seeing if we can help them in other areas of their business as well, which is something we have done traditionally and done quite successfully as well.
And then on the Belgian acquisition, are they operating right across Europe from Belgium, or is it a bit more localized to Belgium, the Netherlands, maybe even France?
No, they operate out of Belgium for several countries across Europe. They already the gas software operates to 17 different markets, 17 different physical markets. So they're able to supply that out of Belgium.
And then if we just touch on the US side of things, in terms of a market entry there, I think it's fair to say it's probably going to be an acquisition. But are you looking ahead more from a US based software provider that's tied into a couple of the big energy tier one energy guys there, or is it more on the services side, looking at maybe that kind of tier two strategy?
I've got an open mind about that, Mark. We've got, obviously, the US is a big market, or a big series of markets. It's a big place with lots of diversity. And so the importance to find the correct entry point and to make it of a meaningful size and importance. So we've got an open mind as to how that might unfold. Obviously, software is traditionally where we've entered the market. But as I said, with the services side of things, if an appropriate opportunity arises, we'll take most of that. It's more important with the US, I think, to get your entry strategy right and to make sure that you don't end up with stranded assets. It's very possible in the US market to do that. You could get marginalized in a certain geography and not be able to break out of that. So I think you have to be very careful about picking the way in and making sure that you make a success of it.
obviously with this Russia-Ukraine conflict that is ongoing, energy security, energy policy full stop is super top of mind in Europe at the minute. Have you heard or seen from the CEOs that are running the UK and let's say the European business now, you know, any big changes in energy policy or regulations that look like they're going to be, you know, very much fast forwarded based on what's happened in the last 2 weeks?
Well, we can just look at the, there was an article on the BBC yesterday in the science and technology section, if anyone's interested. It's sort of summarising the global policy, the sort of European policy response to this. Obviously a very unfortunate set of circumstances for everybody, that our industry should be getting promoted by these unfortunate circumstances. But nonetheless, European policymakers have leapt into action. There's a very interesting story on that. And there's a whole bunch of policy levers they're going to pull on. And these sorts of things are supported by anecdotal feedback we're getting. Obviously, every time that these sort of changes happen, we're looking at trying to increase the resilience, increase the diversity of sources, increase the way that we, the sort of liquidity of those markets and the ease of trading in those markets, and to obviously get the prices down, the costs of trading down. So anytime that dialogue happens, of course, it creates some discussion about how that might happen, be they both commercial solutions or physical and engineering solutions. In the long run, of course, we will probably see more renewable energy. It will probably kick along the renewable energy conversation and debate. But in the short term, there'll be a whole bunch of discussion as well about, you know, how we do things and what policies they can tweak to improve things.
And I just want to come back to Australia for a second. You talk, you know, 50% of, you know, the market kind of passes over your systems in one way or another. Have you come up against questions about, you know, competition and being, you know, so dominant in the market? And that's one part. The second part is then, you know, how much growth can come from Australia, given, you know, how big a player you are within, and I'm assuming it's just the NEM, you're not talking about the WA market here.
Well, we are active in the WA market as well, but of course that's part of the NEM now. It's operated by AEMO, so it's but to your point, generally speaking, participants in the NEM have choices about how they trade and submit their offers or bids or capture their contracts. So they're not obliged to procure from Energy One. It's more of a choice, which I guess is a good thing, in as much as we've been able to capture that by choice. So it's not like you're obliged to use the software in any way, shape, or form. There's always an alternative. So we don't anticipate ever being in a situation where competition is a factor, certainly in the core business. As for growth in that market, well, we've maintained steady growth. We published a stacked line chart in the last presentation that's available for anyone to look at. It's shown over a number of years we've been able to produce growth from the Aussie market. Yeah, it's not exponential growth or anything like that, but it is solid growth year on year, and that's something we're proud of. And I think it points out that the products and services are relevant and are obviously cost effective and are doing good work for our customers.
And then maybe a final question. We can just talk about pricing. What I guess is the environment for, I'm talking in the SaaS business now, of, you know, leveraging, you know, those kind of long-standing relationships in terms of trying to, you know, push up prices, whether it's year over year or, you know, locking people in on a kind of multi-year kind of deal, but maybe pay monthly.
Well, obviously, any sort of commercial transaction is prosperous when it works for both parties. So, you know, the the idea is that the solutions continue to provide value for money, and that we remain in touch with our customers and their needs, and that they're seeing they get value out of the software at the right sort of price. Nonetheless, obviously escalation is important for all of us. The costs do increase each year, and we would traditionally have a CPI type clause in each of these contracts that enables us to match our revenue with some cost increases as they go up each year. Traditionally, customers do sign long contracts with us. They might initially be 1 to 3 years, and they would typically roll over annually after that. And that's the sort of level of involvement we have. They may be paying monthly or quarterly, but the contracts are typically annual evergreen contracts. And that means that the customers stay with us for long periods of time, because obviously, as I said, if both parties are benefiting from the relationship, then it'll endure.
A couple of questions from the audience, Shaun, before we finish. The other 50% in Australia, do they use another provider, or do maybe some of the larger guys have their own internal systems that just integrate with the market itself?
Yeah, that's probably closer to the reality, because our 50% number is sort of based on volume. So there's some larger players that have still got some internal systems, and we call them legacy systems traditionally. There are a couple of competitive systems that have been installed over the years, and then there's a sort of a patchwork of point solutions and so on below that. But so the main answer would be in-house systems. They say about Excel, it's the most popular deal capture system in the world. Of course, not very auditable, but certainly very flexible. So you're always sort of dealing with the internal system, the internal build, and that's something that's just a reality, especially with larger customers.
And then another question, can you expand on the competitive landscape? So I think maybe if we just take that by geography first, so if we take the landscape in Australia currently and then landscape in Europe currently.
Yeah, sure. Well, I'm happy to do that, but of course we do have a slide on this from a couple of years ago. The landscape is sort of we've got these global players. They will be big companies or big suppliers that would fancy themselves to be able to operate in their geography. They're traditionally out of the US, big name companies. Then you've got below that, you've got the regional powerhouses, to use that microeconomic term, of which we would be the regional powerhouse here and feel that we're strong in this particular geography. There would be someone similar in Europe who felt they were strong there. And then below that, you've got the local, what they call local heroes. People would be strong in a certain subject, in a certain geography, very strong in Germany perhaps, or very strong in Italian gas or something of this nature, who would be the point solution. So we consider ourselves to be a regional powerhouse here. We are looking to be a regional powerhouse in Europe, and also a global challenger in time to challenge the big guys.
Okay, Shaun, we're just pushing up exactly on time, so I think we will leave it there for this morning. Thank you very much for joining us once again and giving us the whistle-stop tour of everything Energy One, and we'll keep an eye out on the ASX for updates over the next couple of months.
Yeah, thank you very much, Mark, for having me. Thank you, everybody, for your time.